Good afternoon, and welcome to our webinar, Bankruptcy Basics for Homeowners. My name is Lourdes Macavinta with Wealth Management Financial Advisors. Here to present Crystal Lindsay, bankruptcy attorney with the Lindsay Law Group. Good afternoon, Crystal.
Thank you, Lourdes. I'm very happy to be here today. As Lourdes said, I am a bankruptcy attorney in Los Angeles and also Long Beach, and I work primarily with individual debtors, assisting them with their financial issues using the U.S. Bankruptcy Code. Today, I'm joining with Wealth Management Financial Advisors to present Bankruptcy Basics for Homeowners. And it's a webinar geared at breaking down the bankruptcy process and how it affects homeowners specifically. However, even if you are not a homeowner and maybe just someone interested in bankruptcy and someone who has questions on the bankruptcy process, I also encourage you to listen. So, what is bankruptcy? I find that it's a common term in our society, but since I've been practicing, I've realized that many really do not understand what bankruptcy is or how the process works. In its most basic terms, bankruptcy is a process that allows consumers and businesses to eliminate or repay some or all of their debts under the Federal Bankruptcy Code. And the Federal Bankruptcy Code falls under the U.S. Code Chapter 11. So for our purposes, we will discuss bankruptcy for consumers, that is, individuals like you and myself. For individuals, bankruptcy can be divided basically into two chapters, or two types. And those chapters are Chapter 7 and Chapter 13. Under Chapter 7, bankruptcy is also referred to as liquidation. And it's referred as liquidation because it allows a debtor or individual to discharge all of their unsecured debts. So any debt not secured by collateral, for example, credit cards, medical bills, or personal loans, anything not backed up with collateral, these types of debts would be discharged, meaning wiped away once your bankruptcy is complete. Chapter 7 is also referred to as liquidation because the U.S. trustee, basically the judge or the prosecutor of your bankruptcy case, may take or sell, aka liquidate, some of your property to pay back some of your debt. However, you may be able to keep the property that is protected under the exemption laws, which I will explain in detail later in the webinar. So under Chapter 7, this is called liquidation. Also available to individuals is Chapter 13. And Chapter 13 is very different from Chapter 7. Chapter 13 is also known as wage earner bankruptcy because in order to file for Chapter 13, you must have a reliable source of income that you can use to repay some portion of your debt. And there are income requirements for both Chapter 7 and Chapter 13. Chapter 13 is typically for those individuals who earn too much and don't qualify for Chapter 7. So if you are a homeowner and you have a substantial income, chances are you may not qualify for Chapter 7. In that case, there's Chapter 13 available. And I'd like to go into a little more detail on Chapter 13 as well because for homeowners, this is likely the chapter that will most benefit them, and I'll explain this later into the webinar. So when you file for Chapter 13 bankruptcy, you basically propose a repayment plan that details how you're going to pay back your debt over the next 3 to 5 years. Your payment period can be 3 to 5 years, and it's based on your amount of income. The maximum period that you can repay the debt is a 5-year plan. The minimum amount that you'll have to pay depends on how much you earn, how much you owe, and how much your unsecured creditors would have received if you filed for a Chapter 7 bankruptcy. There are also debt limits under Chapter 13 bankruptcy. Your debts must be within limits set by the federal government. Currently, the limits are you can have no more than $1.1 million in secured debt and $383,000 in unsecured debt. So that's a little about the two types of chapters for individual debtors. Now I want to go into how bankruptcy can benefit or help homeowners. If you're a homeowner who is struggling to pay your mortgage and dealing with financial difficulties, bankruptcy offers certain tools that can benefit you and help you with your financial difficulties. One of the biggest benefits and tools that bankruptcy gives homeowners is that it prevents and stops the foreclosure process. Under both Chapter 7 and Chapter 13, as soon as an individual files bankruptcy, the automatic stay goes into effect. This automatic stay is basically an injunction that stops actions by creditors, including any action to collect the debt. So if a homeowner is going through foreclosure and they have a sale date on record, as soon as that homeowner files the bankruptcy petition, whether it's Chapter 7 or Chapter 13, the sale date must be removed and the foreclosure process must be stopped. Another benefit that bankruptcy can offer homeowners is that it allows them to discharge debt and create more income. Discharge means that the debt is essentially wiped away and you no longer owe it and it can no longer be collected. The money that you would have used to pay these debts is now available for other uses, of course. And you're essentially creating more disposable income through bankruptcy. And this, of course, is always a positive for homeowners dealing with mortgages. Another benefit to bankruptcy is that it improves your income to debt ratio. Bankruptcy has for homeowners is that in the long run, it improves their chances of successfully refinancing or modifying their home loans. When a homeowner attempts to refinance or modify their loan, their lender always reviews the homeowner's financials, and one of the factors that lenders look at closely is a homeowner's income to debt ratio, meaning how much income are they bringing in versus how much do they owe to their creditors. In my experience, I've realized that many of my clients fail to realize that the amount of debt they're carrying around is important to creditors and the offers and the credit that they extend to you in the future. A person, for example, could be earning $100,000 a year, but if they are at the same time carrying around a substantial amount of debt, then their creditors and lenders will see this and it will affect your chances of refinancing or modifying your home loan. Next, I want to discuss how bankruptcy specifically affects a homeowner's home and their mortgage payment. So under both Chapter 7 and Chapter 13, the automatic stay goes into effect as soon as the debtor files the bankruptcy. This, of course, isn't the end, and each chapter affects a homeowner's home and mortgage differently, and I want to discuss the effects of both chapters. I'll begin with Chapter 7 and what happens to a person's home and mortgage under a Chapter 7 filing. So one of the most important and determining factors in dealing with homeowners in bankruptcy is whether there is any equity in the property. If there is no equity in the home, as is the case with many homes in Southern California, if there's no equity, then it's simple. The homeowner gets to keep the home. Since there isn't any equity, then the U.S. trustee in your bankruptcy case has no incentive to sell your home because it's underwater with the mortgage payment. And even if he tried to sell the home, it wouldn't turn a profit anyway. So if there is no equity in your home, then you get to keep your home. However, if there is equity in your home, then it gets a lot more complex. If there is equity, then you must determine how much equity exactly and whether the amount is covered by the homestead exemption in California. So under the U.S. Bankruptcy Code, a homeowner can exempt, meaning protect a certain amount of equity in their home. There are federal exemption amounts and there are state exemption amounts. Here in California, we follow strictly California exemption amounts, and these are called the California Homestead Exemption. Due to time, I really can't go into all the details and everything, but I will say that the California Homestead Exemption offers debtors two options. There are two different systems. There is System 1 and there is System 2. System 1 offers the highest exemption amount. Under System 1, a single homeowner can exempt up to $75,000 in equity in their home or up to $100,000 of equity in their home if there is more than one person in the household. So under Chapter 7 bankruptcy, you can keep your house if you have no equity in the home, or if you are able to exempt, meaning protect whatever equity you have in your home under the exemption amount. However, if there is equity in your home, and again, if it is not all covered by the state exemption amount, then this is, again, when homeowners risk the U.S. trustee taking and selling their home. However, the amount of equity in the property is very important. For homeowners who do have equity in their home, you have to determine if you have enough non-exempt equity, that is, equity not protected by the homestead exemption, to trigger a sale by the U.S. trustee in your bankruptcy. So I want to go over how you determine whether there's enough equity in your home to trigger a sale in Chapter 7. First, you start with the market value of your home, meaning how much your home is worth at this time. Then you subtract the amount of the homestead exemption you are entitled to claim. So if you are a single person in your household, you would subtract $75,000. Next, you have to subtract the U.S. trustee's commission. The U.S. trustee would be paid a commission on the difference. Typically, it's 25% of the first $5,000, 10% of the next $50,000, and 5% of the rest, going all the way up to $1 million. Next, you would have to, of course, subtract the cost of the sale, the amount of money it would take to sell the home. This is usually around 8% of the market value. You would then subtract the amount owed on all your mortgages, and then you would finally subtract all of the non-mortgage liens secured by the home. So if you had a tax lien that was recorded, you would subtract this also. After these calculations, if you end up with a negative number, you do not have sufficient equity to trigger a sale. This essentially means that the Chapter 7 U.S. bankruptcy trustee would not have an incentive to sell your home, since there would not be anything left over to use to pay your unsecured creditors. However, if you calculate and you end up with a positive number, this is the amount of equity that the bankruptcy trustee could use to pay your unsecured creditors. In this case, the Chapter 7 U.S. trustee may sell your home, give you the amount of the homestead exemption, pay off the mortgage, and use the rest to pay off your unsecured debts. Let's now move on to Chapter 13 and what happens to a homeowner's home and mortgage under a Chapter 13 filing. So again, under Chapter 13 filing, instead of discharging debts, an individual proposes and submits a repayment plan to the court to pay off their debts. Basically, you are saying to the court that this is what I have, this specific amount of income, and I cannot afford to pay my debts in full, so instead I propose to pay these amounts, which are all laid out in your plan. It's also important to add that in the repayment plan, debts are paid by priority, meaning certain debts must be paid first before others. In Chapter 13, first, your administrative claims must be paid. Any administrative debts must be paid in full. These are your filing fee with the court, the U.S. trustee's commission, and your attorney's fees. These are paid first and in full. Next, your priority debts are paid, and these are certain debts that must be paid and included in the repayment plan and paid in full also. For example, these are IRS debts, debts to government agencies like traffic tickets or parking tickets. Any type of priority debt must be paid in full 100% in your repayment plan. Next, any mortgage arrears must be paid 100% also in the repayment plan. Any back mortgages that you owe, all of this must be paid and made up in the repayment plan 100%. And then lastly, your unsecured debts are then paid. These are your credit card debts, your medical bills, your personal loans. These debts do not have to be paid in full. Your unsecured creditors will only receive what is left over of your income after paying all of your priority debts. So if a person has nothing left over in income after paying their administrative fees and their priority debts, then he or she's unsecured creditors would get nothing. Furthermore, once the repayment plan is complete, any remaining unsecured debts would be discharged or wipe away, similar to Chapter 7 bankruptcy. So what if you are a homeowner who is behind on your mortgage and you have accrued substantial mortgage arrears? For these homeowners, I typically recommend a Chapter 13 filing because, again, your mortgage arrears can be included in your Chapter 13 repayment plan. In essence, a Chapter 13 allows homeowners to catch up on mortgage arrears and avoid the foreclosure process. However, it's very important to note that in a Chapter 13, a homeowner must keep making their monthly mortgage payment on top of the mortgage arrear payment. And so in order to qualify for Chapter 13, a homeowner must have solid and adequate income. If that homeowner fails to make their regular monthly mortgage payment, then the lender can foreclose even if the Chapter 13 plan is in place and even if that person is making all of their payments in the plan. You have to keep paying your regular mortgage payment. So if you are a homeowner who has been unable to pay their mortgage for a substantial amount of time and you've accrued substantial arrears, you should definitely consider Chapter 13 bankruptcy because, again, it allows you to pay off these arrears through the bankruptcy. Next, I want to take some time to discuss lien stripping through bankruptcy. And this is by far one of the biggest benefits to a Chapter 13 bankruptcy filing, lien stripping. So lien stripping through bankruptcy, how does it work? Basically, the easiest way to explain it is by example, which I will provide. Let's say you are a homeowner and your first mortgage is secured by the entire value of your home, meaning you have no equity in your home. If this is the case, then you will likely be able to strip any second and third mortgages from the home. You'll be able to strip these from the property through a Chapter 13 bankruptcy. In cases where there is no equity in the home, the bankruptcy court will modify certain debts secured by the property. So a second mortgage, for example, if the amount you owe is greater than the value of the property. So essentially, the amount of the debt equal to the value of the property remains secured, meaning the collateral can be taken to pay the debt if you don't make the payments. And the remainder of the debt becomes part of your unsecured debt and is treated as a non-priority debt. As I explained earlier, non-priority debts are paid last. So this means you will pay less or possibly even none of it in your repayment plan. So lien stripping allows you to get rid of unsecured liens on your property. When a mortgage or lien is put on your house, its priority is against other liens, and its priority is typically determined by when the lien was recorded with your county. For the most part, the earlier recorded lien has priority over any subsequent liens. So if your house gets foreclosed on, the first mortgage lender will be paid from the sale proceeds before the lender of your second mortgage sees any of that money. And just so everyone understands the concept of lien stripping, I want to go over an example. So say you own a house and it's worth $300,000 and you have a $400,000 first mortgage. In this situation, you can strip any liens that are junior, meaning that have come after your first mortgage. So if you had a second mortgage with a balance of $100,000, you can get rid of it through lien stripping in a Chapter 13 bankruptcy. Because the two loans combined greatly exceed the value of your home, here in the Central District of California, the bankruptcy court makes the second mortgage an unsecured claim, which then takes last priority in the repayment plan. So a homeowner would likely pay little or nothing at all on a second mortgage that has been stripped from the property. The loan, after the repayment plan, the loan would then be completely discharged after the repayment plan is complete. And that is lien stripping through Chapter 13 bankruptcy. Next, I would like to move on to homeowners association dues and how they are treated in bankruptcy filings. So many of my clients here in LA and in Long Beach area have HOA fees attached to their properties and their homes. There are three main factors that determine what happens to these HOA fees in bankruptcy. First, under what chapter is your bankruptcy being filed? That's the first determining factor. Second, does the homeowner plan to keep or surrender the property? And third, is the HOA secured or unsecured? And again, by secured or unsecured, I mean, is there a lien recorded for those HOA dues? If there's a lien recorded for the HOA dues, then it is treated as a secured debt. If there is no lien recorded for the HOA, then it is treated as an unsecured debt. So let's start with Chapter 7 and what happens to HOA dues under Chapter 7 bankruptcy. If the homeowner is surrendering the property, then the HOA dues will be discharged whether they are secured or unsecured. So once the bankruptcy is complete, the HOA dues will be discharged and wipe away. However, this is not the case if the homeowner is not surrendering their property and is instead keeping the property. If the homeowner is keeping the property and the HOA is unsecured, then it will be discharged in the bankruptcy. However, if the HOA dues however, if the HOA dues are secure, meaning there is a lien recorded, then the HOA dues cannot be discharged and the homeowner will still be liable after the bankruptcy is complete. For this reason, I recommend for homeowners who are dealing with high HOA dues, I always recommend that they look into a Chapter 13 bankruptcy instead, because again, any secured HOA dues in a Chapter 7 bankruptcy would not be discharged. Let's now look at HOA dues in a Chapter 13 bankruptcy. If the homeowner is surrendering the home in the bankruptcy, then both unsecured and secured HOA dues are included in your repayment plan. After the plan is complete and all payments are made, whatever remaining balance for the HOA dues is left over is discharged and wiped away. However, if the homeowner is keeping the property, the options are very different. In the case that a homeowner is keeping the property, if the HOA dues are unsecured, the HOA dues will be included in the repayment plan and will be paid last with any other unsecured debt. After the repayment plan, any remaining balance will be discharged. However, if the HOA is secured by a lien, it is also included in your repayment plan. However, this is where equity in your home plays a big part. If there is equity in your home, then the HOA dues must be repaid 100% in a homeowner's repayment plan, meaning the homeowner would have a maximum of 5 years to pay off the HOA dues. There would be zero interest, but the plan would have to accomplish paying 100% of the dues owed, and there's no way of getting around this. But if there is no equity in your home, then this changes things dramatically. If the property's value is exceeded by its first mortgage and there is no equity in the property, then the secured HOA dues are treated as unsecured debt by the bankruptcy court. And this is another example of lien stripping, which I explained earlier. So the HOA dues are treated as unsecured debt, and they're treated as unsecured in the homeowner's repayment plan. After the repayment plan is complete, the HOA's remaining balance will be discharged and stripped from the property, just as with second mortgages and lien stripping. And that concludes my section on HOA fees and bankruptcy. Lastly, I'd like to discuss bankruptcy and how it affects one's credit score. So as most know, a bankruptcy is treated as a negative event by the 3 major credit bureaus, and it must be reported by the 3 major credit bureaus. A completed Chapter 7 bankruptcy will stay on your credit report for up to 10 years. Again, it's important for people to realize that once your Chapter 7 is complete, your unsecured and possibly even some of your secured debts are discharged and wiped away. So because all debts associated with your Chapter 7 bankruptcy are discharged within a few months of filing, they should begin to drop off your report a few years before the bankruptcy itself does. In general, discharged debt drops off a credit report after 7 years. And so basically, as the items on your report associated with the bankruptcy gets older, they will have less and less of an effect on your credit score. Under a Chapter 13 filing, the bankruptcy itself and the debts associated with the bankruptcy will be displayed differently on your credit report. A completed Chapter 13 bankruptcy will stay on your report for up to 7 years, and the discharged debts will also stay on the report up to 7 years after they are discharged. Since many debts will remain active in a Chapter 13 bankruptcy until the end of the 3 to 5 year payment plan, the debts itself that were discharged could actually remain on the report longer than the bankruptcy itself. For many of my clients, one of their biggest concerns is their credit score and how it will be affected. Again, I have to emphasize that bankruptcy is a negative event. However, what I find most of the time is that prior to bankruptcy, most of my clients' credit scores have already dropped and suffered due to late payments, missed payments, and defaults. If a person's credit score has already suffered prior to the bankruptcy, then they can expect a modest drop in their score if they file for bankruptcy. However, if your score was high prior to bankruptcy and you had a good history of payment, then you can expect your score to drop greatly due to the bankruptcy. Unfortunately, that's just the nature of the credit game. Another big concern that I hear is whether a person will be able to establish credit after the bankruptcy. Basically, will creditors extend credit to you again? Again, this also depends on your credit history prior to your bankruptcy filing. If your score was poor prior to filing, then it will, of course, still be difficult to get credit just as it was before you filed bankruptcy. But I want to emphasize it's not impossible. Within the last 5 years, there has been a surge in bankruptcy filings, and so many lenders and many creditors have realized that they must work and do business with people who have bankruptcy filings on their credit reports. More and more people are having to file, and creditors realize this. And finally, one last thing, I always recommend that after filing bankruptcy, once it is complete, I always recommend that my clients start rebuilding and restoring their credit immediately. There are companies out here who specialize in credit restoration. Wealth management offers a service, and what they do is basically go through your credit report and dispute any negative events. I always recommend that clients do this once their bankruptcy is complete because it's important to start rebuilding and reestablishing credit. And that concludes my presentation of Bankruptcy Basics for Homeowners. At this time, I'm going to turn it over to Lourdes so that we can take some questions from our listeners.
Thank you for that information, Crystal. That was really informative. We have a question coming in from Pasadena. I have already filed a Chapter 7 bankruptcy, but I was wondering if I should file a Chapter 13 now because I have a HELOC, which is a home equity line of credit that I cannot pay. If I have equity in my property, can I discharge my HELOC through Chapter 13?
Thank you for that question from our viewer in Pasadena. So basically, if you have a HELOC account, if you filed for Chapter 7 bankruptcy, there's a certain amount of time that you must wait, and it depends on the state, before you can file a Chapter 13 bankruptcy. Regarding your HELOC account, if there is equity in your property, then it will be hard to strip the HELOC from the property in a Chapter 13. If there's, it depends on the amount of equity that is in your property. If it is a substantial amount and the U.S. trustee sees this, then there really is no incentive to strip away the HELOC account because it is supported by equity in your home. So it depends on the amount of equity there is in your home, and that determines whether you can strip the HELOC account or not. If there is no equity in the home, then it would be treated like a second mortgage, and that secured debt would be made an unsecured debt by the bankruptcy code. But again, it depends on the amount of equity exactly. And just as I went over the calculations and figuring out whether there's enough equity to trigger a foreclosure or, excuse me, to trigger a sale by the U.S. trustee, you have to do these calculations. So it depends on the amount of equity in your home specifically.
Great. Thanks for that answer. We have a question coming in from Long Beach. Can I keep my car if I file a BK and it is not paid off?
Thank you for that question. That's a very good question. Whether you can keep your car depends on how much the car is worth and how much you still owe on the car. If there is sufficient equity in your car, meaning you have value in the car that the U.S. trustee sees, then if there is that equity in the car, the U.S. trustee could take your car and sell it in the bankruptcy. But if the car has low value and you still owe a good amount on the car, then what you would do is the U.S. trustee would not take the car, but instead you would reaffirm that debt, meaning you would tell the U.S. trustee that you intend to keep making payments on the car and you want to keep the car. So it depends on the value of the car and basically how much the car is worth. Is it worth, does it have any worth where the U.S. bankruptcy sees the need to take it and sell it to pay off your creditors? If there is no worth, then you don't have to take that risk. What you would do is basically reaffirm and agree to keep making payments on the vehicle.
Great, thank you for that. Our next question comes from La Mirada. If my foreclosure was dismissed with my bankruptcy, how soon after it was dismissed can I purchase a new home?
I'm sorry, could you repeat that question, Lourdes?
Sure. If my foreclosure was dismissed with my bankruptcy, how soon after it was dismissed can I purchase a new home?
Okay, so if your bankruptcy was dismissed, meaning you did not receive a discharge, it would depend on your credit score and your payment history. If your case was dismissed, then you don't have the bankruptcy on your credit report. It means you filed, but it did not go through, it was not complete and was dismissed. So this would not be on your credit report. So whether you can buy a new home or not, it depends, of course, on your credit score, your amount of income, your income to debt ratio. It depends on a number of factors. But if your bankruptcy was dismissed, that means it does not appear on your credit report and it should not have any effect on purchasing a new home. It means you filed for bankruptcy, but it was not completed.
Great, thank you for that. Next question coming from Palos Verdes. Do I need an attorney to file any kind of BK?
Technically, you do not need an attorney to file a bankruptcy. It's not required by the court. You can represent yourself in your own bankruptcy case. However, I strongly advise any individual or person who is serious about a bankruptcy filing, I always recommend that they hire an attorney. The bankruptcy code is complex, and honestly, it can be hard and difficult to maneuver through. There are several forms. There are over 30 forms in a Chapter 7 bankruptcy filing alone. So yes, you can. Legally, you are able to represent yourself in your bankruptcy, but given the complexity and the nature of the bankruptcy code, I always recommend that someone hire an attorney. I've seen clients where they try to represent themselves, and it just, there were errors. The court dismissed their case, and in the long run, they had to go ahead and hire an attorney anyways in the long run. So I recommend that you save your time and you save your money in the beginning and just go ahead and invest in a bankruptcy attorney. There are people out there, for example, paralegals who offer help with bankruptcies and filling out the bankruptcy forms, but those paralegals cannot be with you in your bankruptcy hearing. So in bankruptcy cases, you do have a hearing that you must attend, at least one, and if there are any disputes or any of your creditors dispute your bankruptcy, then you will have more hearings. And a paralegal cannot represent you in a bankruptcy hearing. You must have an attorney. And I really don't recommend trying to represent yourself in a bankruptcy hearing too. I've seen many people get burned that way and have had to just hire a BK attorney in the long run. So I always recommend that you hire an attorney to handle your bankruptcy for you.
Great. So everyone listening, make sure to hire a bankruptcy attorney if you're thinking about filing a bankruptcy. Our next question comes in from Washington. I cannot afford to make payments on my HELOC account. Can I discharge this through bankruptcy? My house is severely underwater.
Okay, that's a great question. I touched on this during the webinar. So if you have a HELOC account, a home equity line of credit, these accounts are typically secured, or not typically, they're always secured by your home, meaning they're a secured debt and the collateral is your home. However, if your home is underwater and there is no equity in your home, then the court here in the Central District of California, the court will treat this HELOC account as an unsecured debt, meaning even though it's backed and supported by your home as collateral, the court will make that secured debt an unsecured debt, and under Chapter 13 filing, that could be stripped away through lien stripping, as I discussed. So yes, if you have no equity in your home, you can strip the HELOC account in a Chapter 13 bankruptcy filing.
Great. Thank you for that. I hope that answers your question to our listener in Washington. Our next question is coming in from Cerritos. What is the least amount of debt that I can discharge in a bankruptcy? I have 4 credit cards with balances of about $1,000 each, and I haven't been able to keep up with the payments. I need relief.
Okay, very good question. So there are no debt amount requirements for Chapter 7 filing, meaning you don't have to have a certain amount of debt in order to file. You could have as little as $500 in debt, and you could get that discharged in a Chapter 7 bankruptcy. So there aren't any debt requirements. You can have any amount of debt and discharge it through a Chapter 7. Chapter 7, though, has income requirements, meaning you cannot make a certain amount of income per month in order to qualify for bankruptcy. But as far as debt amounts, there are no limits on the amount of debt that you have. However, under Chapter 13 bankruptcy, there are limits, which I discussed earlier. But under Chapter 7, there are no debt amount requirements.
I have another question. If someone has tax liens or property tax liens or maybe income tax liens placed on their property, would you be able to discharge that through bankruptcy or strip it with your lien stripping? I apologize.
Very good question. So tax debts, IRS debts, tax liens that have been recorded against you on your property, those types of debts are considered priority debts. And typically they cannot be discharged through a bankruptcy. There are certain situations where if very specific requirements are met, then you can discharge them. But if those requirements are not met, you cannot discharge them. For the most part, IRS debts cannot be discharged through a bankruptcy. And if I would recommend talking to an attorney specifically to see, when the debt was owed, if there was any fraud or tax evasion involved. These are all factors that determine whether you can discharge or not. But typically, for the most part, you cannot discharge IRS debts in a bankruptcy. Those are considered priority debts, and they have to be, they must be paid even in a bankruptcy. Other priority debts are, for example, child support payments. You cannot discharge child support payments through bankruptcy. You have to keep making those payments. And the court, of course, has good reasons for not allowing those types of debts to be discharged in a bankruptcy.
Thank you for that. We have one last question coming in from Paramount. How long will bankruptcy affect my credit, and how much will it affect my credit, and how soon after I file can I start to restore my credit?
Very good question. So as I touched on earlier, a Chapter 7 bankruptcy will stay on your credit report for 10 years. A Chapter 13 bankruptcy will stay on your credit report for up to 7 years. So the three major credit bureaus, they have to report a bankruptcy. Whenever you file, they have to report it to the three major credit bureaus. And it does stay on your report. Chapter 7 again for up to 10 years, and Chapter 13 again for up to 7 years. It's nowadays, like I said, more and more people are filing for bankruptcy, so creditors and lenders do understand this, and they have realized this. So it won't be impossible to reestablish credit. It's not impossible. There will be creditors out there who will still extend you credit even with a bankruptcy on your record. But again, it is a negative event, and creditors will look at it, and it will affect your credit score. Your credit score will drop from a bankruptcy, like I said earlier. But if you were not making payments to your creditors to begin with, then it's not going to be a huge drop. It'll be a modest drop. But if your credit was very good before the bankruptcy, then you can expect a pretty big drop in your score. And I believe that was our last question. So this concludes the webinar, Bankruptcy Basics for Homeowners. Again, my name is Crystal Lindsay, and I am a consumer bankruptcy attorney here in Los Angeles and Long Beach. I want to thank everyone for listening and everyone who submitted questions. And also a big thank you to everyone at Wealth Management Financial Advisors for providing me the opportunity to discuss and inform listeners of bankruptcy basics.
Thank you so much for that information, Crystal. It was very helpful. At this time, I'm going to open up one last time to the listeners out there who are listening on the phone. If you have any questions, press #7 to ask them now. Do we have any other questions to our listeners on the phone? Okay, I think that will do it for us today, Crystal. Again, my name is Lourdes Macavinta, Specialized Marketing Manager here at Wealth Management Financial Advisors. We thank you for your time, and thank you, Lindsay, with the Lindsay Law Group. Your information can be found on the page and on the last screen that you are viewing of the slides. And you can reach us here at Wealth Management Financial Advisors at www.wealthmanagementlb.com. Everyone, thank you for your time, and enjoy the rest of your day.